Have you ever looked at the price of silver and thought something just doesn't add up? You see the spot price on your screen, the one Wall Street tells you is the real price. But then you try to buy an actual physical silver coin or bar, and suddenly the price is much higher. What's going on here? Is it just a simple premium, or is there something deeper happening? A fundamental disconnect between the paper market and the physical world? Today, we're diving deep into this fascinating puzzle. We'll unravel why Wall Street's valuation formulas for silver seem to be breaking down and what this divergence means for you as an investor. This isn't just about numbers on a screen, it's about the tangible value of real money. Let's start with the basics. Now, for decades, the price of silver has been largely determined by futures contracts traded on exchanges like the COMEX. This is the paper silver market. Giant banks, hedge funds, and institutions trade massive amounts of these contracts, which are essentially promises to deliver silver at a future date. The price you see quoted everywhere, the spot price, is derived from the trading of these paper instruments. And for a long time, the system worked more or less. The paper price and the physical price stayed relatively close, with a small, predictable premium for minting, shipping, and dealer costs. But recently, that gap has widened into a chasm. The premiums on physical silver, things like American Silver Eagles, Canadian Maple Leafs, or even generic silver rounds, have skyrocketed and stayed stubbornly high. You might hear explanations like supply chain issues or high demand, and while those are partially true, they don't tell the whole story. The real issue is a crisis of confidence. A growing number of investors are realizing that the amount of paper silver being traded is vastly greater than the amount of actual physical silver available to back it up. Some estimates put this ratio at 100 to 1, 200 to 1, or even higher. Think about that. For every 100 ounces of silver promised on paper, there might only be 1 ounce sitting in a vault, ready for delivery. This is where Wall Street's formulas start to fall apart. Their models are based on a world where paper and physical are interchangeable. They treat a futures contract as if it's the same as holding a bar of silver in your hand. But what happens when everyone wants the real thing at the same time? The system can't handle it. It's like a bank run, but for precious metals. If even a small fraction of contract holders decided to stand for delivery and take their physical silver, the vaults would be emptied almost instantly. This is the risk that the paper market systematically ignores, but the physical market is screaming at us. The high premiums on physical silver aren't just a dealer markup, they are a signal. They are the market's way of telling you that physical, in-your-hand silver is much scarcer and more valuable than the paper price suggests. It's a risk premium. People are willing to pay more to have the certainty of holding the actual asset, rather than a promise from a counterparty that might not be able to deliver when it matters most. So, what drives this physical demand? It's not just collectors, it's a flight to safety. In a world of rising inflation, currency debasement, and geopolitical instability, investors are seeking tangible assets that can't be printed out of thin air. Silver has been real money for 5,000 years. It has no counterparty risk. When you hold a silver coin, you don't need a bank or government to tell you it has value. Its value is inherent. This is a concept that is becoming increasingly attractive as faith in traditional financial institutions wavers. Furthermore, silver's industrial demand is exploding. It's a critical component in solar panels, electric vehicles, 5G technology, and countless other green energy and high-tech applications. This industrial consumption is not optional, it's essential. And it's eating into the available above-ground supply every single day, putting even more pressure on an already tight market. Now let's consider the implications for you, the investor. If you're investing in silver through a paper product, like an ETF or a futures contract, you need to understand what you actually own. In most cases, you own a share in a trust or a paper claim, not the metal itself. You're exposed to the very counterparty risk we've been discussing. While these products can be useful for short-term trading, they may not provide the long-term security and wealth preservation that many people seek from precious metals. You are essentially betting on the paper price, which we've established is disconnected from physical reality. When you buy physical silver, you are opting out of that system. You are taking direct ownership of a real asset. You're paying a price that reflects the true supply and demand dynamics in the real world, not the manipulated dynamics of the paper market. The divergence between the two prices is your opportunity. It suggests that the physical market believes silver is fundamentally undervalued by Wall Street. Eventually, reality has to set in. The paper charade can't go on forever. At some point, the price discovery mechanism will have to shift back to the physical market. And when it does, the paper price will be forced to catch up with the physical price, not the other way around. This could happen in a number of ways. It could be a force majeure event on the COMEX, where they are unable to deliver the physical metal and settle contracts in cash. It could be a major industrial user or even a sovereign nation deciding to bypass the paper markets and secure large quantities of physical silver directly from refiners, draining global inventories. Or it could be a slow, steady bleed as more and more individual investors choose to stack physical metal, creating a grassroots movement that overwhelms the paper system. So what's the takeaway here? Don't be fooled by the spot price you see on TV. It's an important data point, but it's not the whole picture. The true value of silver is being revealed in the physical market, in the price people are willing to pay to hold the real thing. The divergence is a warning, but it's also a massive opportunity. It's a sign that a major repricing event may be on the horizon. By understanding this disconnect, you can position yourself to benefit from the inevitable return to sound money and honest price discovery. Do your own research, understand what you're buying, and consider whether you want to own the promise or the real thing. The choice you make could have a significant impact on your financial future. Thank you so much for joining me on this deep dive into the silver market. It's a complex topic, but an incredibly important one. If you found this information valuable, please hit that like button and subscribe to the channel for more content that looks beyond the mainstream headlines. And I'd love to hear your thoughts in the comments below. Do you stack physical silver? What are your predictions for the future of the market? Let's get the conversation started. Thanks for watching, and I'll see you in the next video. Have you seen what silver has been up to lately? The silver market just had a huge moment, jumping over 4% in a single day. This wasn't just a random blip on the radar. It was one of its best single-day performances in months, and it's got everyone talking. What caused this sudden surge, and more importantly, is this the start of something much bigger for silver? Today, we're diving deep into the silver market. We'll break down the immediate triggers for this rally, look at the powerful long-term forces that could push silver even higher, and discuss the very real risks every investor needs to be aware of. Whether you're already holding silver or just curious about what's happening in the precious metal space, you'll want to stick around for this comprehensive analysis. Let's get into it. So, what exactly lit the fuse for this price explosion? The main catalyst was the latest U.S. jobs report. The numbers came in weaker than expected, signaling that the super hot job market might finally be cooling down. Why does this matter for silver? Because a cooling economy makes the Federal Reserve more likely to cut interest rates. When interest rates go down, holding non-yielding assets like silver and gold becomes much more attractive compared to savings accounts or bonds that are now paying less. Lower interest rates also tend to weaken the US dollar. Since silver is priced in dollars globally, a weaker dollar makes it cheaper for buyers using other currencies, which naturally boosts demand and pushes the price up. It's a classic inverse relationship. So that weaker jobs report was the perfect piece of news for silver bulls, and the market reacted almost instantly. This wasn't just about the jobs data, though. It was the confirmation of a trend that many had been anticipating, providing the spark for a significant move. Now, while a single economic report can trigger a short-term rally, the real story for silver is much bigger than that. There are powerful, long-term forces at play that could support its price for years to come. And let's start with industrial demand, which is silver's secret weapon. Unlike gold, over half of all silver demand comes from industry. And right now, two of the biggest industrial revolutions are incredibly silver-hungry: the green energy transition and the artificial intelligence boom. Solar panels, for example, require a significant amount of silver. As the world pushes for more renewable energy, the demand for solar panels is skyrocketing, and so is the need for silver. Similarly, the entire electronics sector, from the smartphone in your pocket to the complex servers powering AI, relies on silver because of its unmatched electrical conductivity. This industrial backbone provides a solid floor for silver's price, one that isn't just tied to investment sentiment. It's tied to global progress. On top of that, we have the investment side of the equation. Silver has been seen as poor man's gold for centuries, a store of value and a hedge against inflation and economic uncertainty. When people lose faith in traditional currencies or worry about a recession, they often turn to precious metals. With persistent inflation and growing geopolitical tensions around the globe, the case for holding a tangible asset like silver as a form of financial insurance is as strong as ever. Many investors look at the gold to silver ratio, which historically shows how many ounces of silver it takes to buy 1 ounce of gold. This ratio is currently quite high, suggesting to many analysts that silver is undervalued compared to gold and has significant room to catch up. When you combine this strong, growing industrial demand with its historical role as a monetary metal, you get a very compelling long-term bullish case. But let's be realistic. No investment is without risk, and silver is certainly no exception. In fact, it's known for being one of the most volatile assets out there. Its price can swing dramatically, much more so than gold. Why? Because the silver market is much smaller and less liquid than the gold market. This means that large buy or sell orders can have an outsized impact on its price, leading to sharp spikes and steep drops. This volatility can be a double-edged sword. While it offers the potential for quick, substantial gains, it also brings the risk of equally rapid losses. If you're an investor who gets nervous during market swings, silver might keep you up at night. Another significant risk is tied directly to its strength: industrial demand. Since over half of silver's demand comes from industry, a global economic slowdown or a recession could hit silver hard. If manufacturing slows down, factories will need less silver, leading to a drop in demand and consequently its price. So, while a cooling economy might lead to interest rate cuts that are good for silver in the short term, a full-blown recession could be very damaging. It's a delicate balance. Investors need to weigh the potential for monetary easing against the risk of an industrial slump. This dual nature, part precious metal, part industrial commodity, is what makes silver so unique, but also so complex to analyze and invest in. So, how should you approach silver right now? It's crucial to see it for what it is: a high-risk, high-reward asset. The recent 4% jump is exciting, but you should never make investment decisions based on a single day's price action. Instead, focus on the bigger picture. Do you believe in the long-term trends of green energy and technological expansion? Are you looking for a hedge against inflation and currency debasement? If so, silver might deserve a place in your portfolio. However, because of its volatility, it's wise to consider it a smaller, more speculative part of your overall investment strategy. Don't go all in. Diversification is key. You could consider physical silver like coins or bars, or you could look into silver-backed ETFs or even mining stocks for different types of exposure. Each has its own pros and cons. Physical silver offers tangible security, ETFs offer liquidity, and mining stocks offer leverage but with added company-specific risk. To wrap things up, the recent surge in silver's price was a fascinating event, driven by expectations of a shift in Fed policy. But the true story of silver is a long-term one, built on the twin pillars of growing industrial demand from unstoppable technological trends and its timeless appeal as a monetary safe haven. However, investors must respect its infamous volatility and its sensitivity to the global economic cycle. There are no guarantees in the market, but by understanding both the powerful forces supporting silver and the significant risks involved, you can make a more informed decision about whether this shining metal has a place in your financial future. It's a complex and exciting market, and we'll definitely be keeping a close eye on it. Thanks so much for watching. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the markets. Let me know in the comments what you think about silver's future. See you in the next video.